We've chosen to call this presentation Winds of Change, and indeed we see some winds of change that may be beneficial for SKAGEN Focus. In particular, we think we're going to go through a number of those building blocks in this presentation on the macro side. We're also going to take a look at the quite eventful summer for the fund. We have seen some really nice industrial interest in some of our assets, which we'll take you through. Also, we'll take a look at the usual portfolio positioning and new investment cases. So you've seen this slide before, of course. What is SKAGEN Focus all about? Just want to repeat this. We are quite a unique investment vehicle, as you may know. We are still contrarian, price-driven value investors looking for a substantial discount to the holdings that we hold to an estimate of fair value. We want to see at least a 50% upside in 2 to 3 years' time in our equity prices on a midterm or normalized earnings power. That's how we come into our more cyclical positions, judging from these normalized earning power levels. We're also an unconstrained mandate, but we have a specific interest for global small and mid-cap positions. We have select large cap positions as well, such as newly initiated Panasonic in Japan, the conglomerate. But we currently hold about 80% in global small and mid-cap value companies. So let's take a look at performance for the year, and this is in euro terms. You'll see that year to date, the fund has performed pretty okay, we must say. I think we're 2 or 3 percentage points ahead of the underlying index. We've had a pretty volatile ride in terms of relative performance. I think we were about 10 percentage points ahead in May. After that, we've seen a mysterious fall in bond yields. We've seen a hefty rotation back into large cap growth, tech companies, US companies, etc. So that's been a pretty wild swing there. But looking at the performance from the pandemic lows in February, March 2020, which we have defined as the big reset, as you all know, in terms of estimates and expectations for cyclical and value assets in particular were actually collapsed. We have not been up against these very low estimates, and the earnings bar have been raised, but there are still some clear tailwinds for value assets in terms of this development. And since then, the fund has it's more than doubled actually, and you'll see that the performance gap versus the actual MSCI country world and also the value index is pretty vast here. We'd like to point out that the overperformance over value is especially we think interesting and shows that the fund can perform in most investment environments over time.
Right, but if we take a step back to put things into perspective and compare MSCI global growth versus value since 1975, we see a significant outperformance from value over time. But during the last years, in the so-called mega cap era, we have seen a significant headwind for value-related investment styles. And there's of course many reasons for that, but one of the main drivers has been the substantial quantitative easing that we have seen from central banks, which has benefited the so-called growth segment. And seen from this perspective, the rotation, even though it might have seemed dramatic over the last years, the rotation in both directions, it can barely be noticed in the larger picture, as you can see on the chart here. And the important point that we want to make here is the relationship between risk and reward in the market at the moment, especially if you compare the type of valuations that we are buying into through our price-driven investment philosophy, and you compare that to the concentrated index basket, which are consisting of highly valued and very crowded large cap tech names. So we think at least there's a very strong argument here for clients to consider a diversification among your own exposures, as the market leadership tend to change very much over time, which you can see here on the next chart. If you look at the sector weighting since 1975 during the same time period, and you can see the growing dominance of tech over the last decade here at the expense of asset-heavy industries. It's also interesting to note that despite the correction we have seen here during the summer among Chinese tech names, we still see this large exposure for tech. And this again highlights the high concentration here and exposure to a very small group of very large US domiciled tech companies, which again highlights and speaks for the argument to have a balanced approach going forward.
So we talked about the winds of change and the building blocks why we think we're entering into a potentially new investment paradigm, if only gradually. We think there are a few items that is worth noticing in this environment. And the first one is the start of what we call the great unwind. As you all know, the quantitative easing that David mentioned has obviously been in place since the great financial crisis and never taken back. They tried to take it back in 2013 in the so-called taper tantrum, which released a huge interest rate upturn, which central banks, of course, wants to avoid at any cost. That's why they're having an extremely gradual approach in their communication. But that does not remove the fact that one of the largest buyer of US treasuries out there, and also the global treasuries, since every central bank has been involved in this, will gradually be removed when these central banks unwind these or stop buying these US treasuries, for instance. So we think this is an interesting point in time, an inflection point in time in terms of this experiment being sort of unwind in financial markets, and we'll see how that goes. That should put some pressure upward on at least longer term interest rates. And we can see here that this is the actual this is only one estimate or one scenario how these purchases from the central banks may be unwind over time. You'll see that the monthly pace now is about $120 billion per month for the Fed, which are buying into treasuries and MBSs and so on. This will gradually fall to nothing at the end of 2022, which will of course be an interesting development to follow. We'll also see a very mysterious fall in these US bond rates. If you go back again, you'll see that the US Treasury 10-year Treasury rate did fall mysteriously from May to into the summer, which of course has affected this rotation we mentioned at the beginning back into large cap growth, tech space, and so on, which has been a relative headwind for SKAGEN Focus over the summer, although we have very positive news from the company specific side, which we'll go through in just a short while. And the other parts of the picture is the extreme dominance of the US equity markets, which also has grown beyond almost belief over the last 10 to 12 years since QE was introduced. And you have the birth and the development of the US mega cap tech companies, basically. And you'll see here the earnings estimates for the S&P 500 is moving sharply upwards. So in this respect, it's no doubt the US market has a pretty good run. However, the bar is now raised. The bar is now quite high for earnings. We might be in a peak earnings revision situation for some of the US side in the US equity markets. The valuation is not low, it's pretty stretched. At the same time, we have finding huge discounts in global equity markets in Japan, in South Korea, in emerging markets, and so on. That's of course where SKAGEN Focus is positioned. We only have about, I think, 12% of our assets in the US, which is a result of us have very difficulties finding any real good value cases in the US. And we think when you turn the investment roadmap upside down, so to speak, the US might be the funding source for other value equities to be funded in this new revised investment environment potentially. So just to sum up, we have mentioned a few factors. On top of this, you have inflation running at very elevated levels, and the central banks and the market has bought that this is only temporary. This might be the case. If it's not the case, I guess the US Treasury rates are in real trouble in terms of where they stand right now. You have a fair probability for the central banks to, of course, remove monetary stimulus by raising short interest rates. That will probably happen in 22 and 23, which will be highly beneficial for financials across the globe, which is ironically our largest sector position, with about 25% of the fund in extremely discounted financial names across the globe. You'll see that if you have this environment, if you have this normalization to occur, you'll see that the market will favor above average near-term free cash flow yields. And that's exactly what SKAGEN Focus is carrying. We're carrying a fair number of cases which are based on a normalization of earnings power, especially these days in travel-related names like Stagecoach and Sixt.
For those of you who have been listening to us before knows very well that this is a price-driven investment philosophy. In SKAGEN Focus, we only take a position if we believe that we can buy it at a significant discount to fair value. Our job is to sell investments at fair value and maintain an attractive risk reward for our clients. So this is price-driven, but we also need to be able to identify catalysts that can support a re-rating for our positions within a 2 to 3 year horizon. And there's a wide spectrum in which we can apply our price-driven philosophy, and we try to diversify among different ways to identify undervaluation, as you can see on the slide here with examples from the fund. Jonas mentioned that we had quite an active summer. Just want to share some highlights from the fund during the summer. First, I want to highlight Europe Corp. Those of you who listened to us before the summer maybe remember that we initiated a position there. It was a short but very profitable ride for us. Europe Car is one of Europe's largest car rental companies. We initiated the position back in May following a substantial debt restructuring. There was a long period of disappointments, as you can see on the small chart there, leaving many investors disappointed, and this reflected in the share price. The asset became completely ignored by the market. As we started to do work, we actually remember that the company struggled to even gather investors to listen to their transformation that they've been through. In fact, so our work indicated that the risk was much lower than perceived, and a much lower cost base that we identified would be much rewarding as things start to normalize. So we took a position, and this undervaluation was indeed confirmed shortly thereafter as a consortium led by Volkswagen offered a cash bid for the share with a takeout offer. So very good news for us there. Then I also want to highlight Stock Spirits. Stock Spirits, maybe it's remembered by some of you, we have been invested in this share twice actually. It's a UK listed spirits producer operating in Eastern Europe, primarily Poland. They're highly cash generative, have a strong balance sheet and are well positioned, but often misunderstood, below the radar and significantly undervalued for different reasons. We have been invested between 2015 and 17. At that point, it was much of a turnaround story. A group of investors, including us, were pushing for change in the company, and we had a very profitable experience from that. And then we came back in late 2019 when the market again underappreciated the company fundamentals. And we recently, during the summer, received a bid from a private equity firm, CVC Capital, who offered a cash takeout offer for Stock Spirit at a 43% premium. So very good news for the fund.
So, and it doesn't stop there actually. We in the middle of August, we also received some very good news surrounding our holdings in Pilgrim's Pride, which has been a 3% position in the fund. It was initiated in the depths of the pandemics in February, March 2020 at around $15 per share. JBS, the main owner of Pilgrims, decided to offer the minorities a buyout at the 22% premium, at $26.50 per share for the remaining stake in Pilgrim's Pride. JBS is preparing a listing of their US unit in the US equity markets, and we have suspected all along actually that the dual listing of Pilgrims and JBS wouldn't make any sense. So this was a pretty something we discussed internally, on top of the fundamental sort of perspectives on Pilgrims being an extremely good asset in the chicken space. Of course, fundamentally doing very well and seems to be delivering very solid results now in the next few quarters. We think, however, the price is a bit too low. We think JBS may be forced to pay up. There's a independent committee now. There's evaluating the bid. The majority of the minority needs to approve the bid. And we suspect that it has to go higher, close to $30 per share. Therefore, we keep half of this position in the fund currently. To sum up, so we have no less than 4 buyouts in 2021, which of course is something that we are very happy about. You'll see the summary here. We had Rox Gold in April of this year, where Fortuna Silver offered a cash and stock bid at a 43% premium to our top 10 position. We did cut back on that position. We are now shareholders in Fortuna Silver. That's a 3% position in the fund currently. We have sold out of Europcar. We have sold out of Stock Spirits on these bid levels, and we keep half of the Pilgrim's Pride position currently in the portfolio. And the performance year to date, you'll see that in euro terms, we're up 21%. We want to highlight Albertsons, which has been a top 10 position, the number 3 food retailer in the US, after Kroger and Walmart, delivering very solid numbers. This has been, of course, quite an obscure holding in typical Focus style with only a 10% free float. Private equity was IPO by private equity in 2020, where we initiated a position around $14-15 per share. It now trades at $28 per share, following some very solid earnings reports. The food at home trend is stronger than expected, and they have essentially de-risked their balance sheet as well during this time. We have cut back somewhat on Albertsons. Few drawdowns in the portfolio year to date, nothing major on the drawdown side actually year to date.
So there has been a lot of activities in the fund as we have been taking profit and some of our leading positions, also closed positions at target, but we have not rested. We have continued to put money to work and added to several of our high conviction names, and also initiated new positions in the fund. So just want to highlight and share with you a little bit what's going on there. So first I want to highlight Stagecoach, which is a UK bus operator. It operates in 2 segments. It's regional buses, but also London city buses, where the contractual nature of this means that profitability has been quite protected, especially during the pandemic, which has been to the benefit of the company. They have a strong balance sheet, which is very important. They have also exited non-core businesses, which has even further strengthened the balance sheet. They have good access to liquidity, good position, strong market position, and will benefit from the normalization of travel going forward. Trading at very attractive valuations, and is currently a 2.4% position in the fund. Also want to highlight DB Insurance, which is a South Korean insurance company. They have a strong market position in an industry that consists only of a few players. And there's a strong case here for increased profitability following a series of premium hikes here in the industry. They're overcapitalized and trading at very, very low valuations. They have started to show signs of willingness to increase shareholder value. They recently bought back 15% of outstanding shares, and there's more low-hanging fruits here. So it's a very strong step in the right direction. It's also interesting, we think, that the domestic industry are now slowly adapting global accounting standards, IFRS 17, which will unmask the current profitability and the high solvency that we see in the industry, especially in relation to global peer, where investors now will have an easier time comparing the companies, which we think will benefit them. So DB Insurance is currently 2% position in the fund.
So we mentioned some of these adjustments, new positions in DB Insurance and Stagecoach. We want to highlight Panasonic is a new top 10 position in the fund. It's a little bit more than 3%. We had a very profitable journey with Hitachi, if you remember, which we initiated in 2019 and hit price target quite recently. That has now been replaced by Panasonic, which is also a sprawling conglomerate in Japan, sharing some of the characteristics as Hitachi, although their underlying business lines are not entirely the same. They have the same plan for focusing their asset base and their activities into core activities, by selling off non-core assets and so on. And we expect this restructuring to propel the value of Panasonic. They have a very interesting battery operating unit, for instance, to EV, which we think is highly undervalued within the Panasonic conglomerate shell. We have sold out of Stock Spirits Europcar. We also left Parex Resources, our sole energy holding, selling out at price target. We now have nothing in that space. We have increased our position in Ubisoft, which is one of the two technology companies that we hold. The video game producer is trading at extremely low multiples on a normalized level. We think they will head into a R&D spending 2 years here. But we see a solid franchise below, which we think the market is pricing too cheaply here at 50 euros somewhere. And we mentioned we scaled out in Albertsons and Pilgrim's Pride. So the top 10 positions of the fund, you'll see here, we mentioned many of these names in this presentation. We can also perhaps name Raiffeisen Bank, which has sailed up on its own machine to a 3.6% position in the fund. It's a extremely discounted Austrian banking group, mainly active in Eastern Europe, rather big Russian operation. They are subject to a litigation lawsuit on Polish Swiss franc loans to retail clients. This has been clouding the investor outlook for this name. We think it's priced in. We think they're going to take it case by case. They are capable of delivering a 10% plus ROE and trading at currently at 50% of book value. So one of the absolute best values, we think, in the European banking space in Raiffeisen here. Can also mention Argonaut Gold being a strong performer for us. We hold a number of assets in the commodity space still, Argonaut Gold, Fortuna Silver, Ivanhoe Mines in copper, Vale Indonesia in nickel, for instance. You'll see that the top 10 is 36%. I can guide that's going to go higher, we think, in the next few months, as we find interesting price points in these assets to further accumulate shares. And we have very solid upside to our price target, 50% to the weighted price target across the fund, thanks to a fresh portfolio where half the portfolio is initiated less than 1 year ago from inception. So, and of course, a very cheap portfolio compared to anything you'll see out there, trading just 1.5 times book at 11 times earnings currently. So just to sum up, we believe there are a fair probability for a scenario that we might enter into a new investment paradigm, which would be a more normalized environment, actually, if you think about how the investment world worked prior to QE. That is what we're thinking about here mainly. And you've seen a few of the building blocks. That would also mean that the US would lose or gradually be reduced its dominance in these equity markets over time. And we have very strong performance from the lows from the pandemic, up over 107% in euros. Several buyouts in the portfolio, industrial values, not surprisingly, since we're dealing with these very undervalued equities. It's no wonder there are some industrial interest for these names. So we would expect to have some of that each year, actually, on the take buyout side. New positions in Stagecoach and DB insurance, and a substantial upside still to our price targets. So this is more or less what we have today.